So hey, I'm Jonathan Romley. I've been a founder of companies in the U.S. and actually more recently in Poland, and on the management team of a company in Ukraine that sold to Google, and also started another company in Ukraine. Okay, so I guess that's why we have flags. I started some companies in some countries. One of them I happen to be in. Very good. So the one I'm going to talk about is Butyl. This is a company that I was not the founder of, a company that I didn't help start, but a company that I helped sell. So not the start, but the finish. And one thing that I learned in this process was, I guess the finish is kind of the objective in a startup after all. So there becomes this question of what's more important, the idea or the execution, and we'll talk a little bit about that. So Butyl was a company that was founded in Ukraine by Ukrainians. One of the first, or actually it was the first technology licensing deal for the National Technical University of Ukraine. So it's the first time that any kind of technology had been licensed out of the university and turned into a company. So also the initial investment came from Ukrainians that were living in the U.S. So actually the company started off as a pretty Ukrainian deal, as a pretty Ukrainian company, and as something that was homegrown and started in Ukraine. So ultimately, the company went to raise $18 million in U.S. venture capital. One of the things that happens when you do that is sometimes the people that started the company don't end up being the people that actually get to work at the company, but that's a different story. So the company sold to Google for $45 million. So why did it work? So one of the interesting things about this is that it's a core technology, universal concept. So if I said I'm making a face recognition company, and that's what Butyl was, we were building face recognition technology, it's pretty easy to understand. You can venture a guess at what the company does. If I say that we're doing face recognition, it's like, oh, okay, so you guys build some technology that must help recognize faces. Simple enough. Everybody understood it. So a global business profile. So the company was based in Silicon Valley at the time that it sold. So we had maybe about 80 people in Ukraine and just a handful of people in Palo Alto. Also some operations in South America for mobile development. And so really, while the company started off as a Ukrainian company, it was really kind of a global business in the end. It's a small company, under 100 employees, but in any case, still with that global footprint, which is important when you come from a market that some people might not always be excited to invest in. Whoops. So an active M&A market demand. So as far as the kind of technology that we were building, we had competitors. Competition's a good thing. If you have no competitors, then you probably have a really bad idea. So no competitors is never good. We had a bunch. They were all, can you imagine, doing the same thing? And each of those companies was acquired by either Google or one of our competitors was acquired by Facebook. So there was an active M&A market. So there were companies that are generally the kind of companies that you want to sell your company to that were actively interested in buying companies that were working on this kind of technology. So it helps if you think about the company as the product, and when it becomes time to exit. That's something you have to start to think about. So, we have our product and we have our company and we have stuff that we do, but you have to take the company as a product and try to sell it in the end if that's the kind of exit, if that's what you're after, if you're not just trying to build a lifestyle business. And in general, when we're building startups, we're not thinking about building a lifestyle business. We're thinking about a lifestyle business, by the way, being a business that just generates enough money for you to have a nice life. Your investors, when you take investors, would not be so happy about that unless you're just going to pay very large dividends. And still, that's not what we're after. So active M&A market, dedicated investors. Speaking of investors, so the investors really got in, and they were not the kind of investors that were like, okay, so here's a check, and you know, if we lose it, whatever. So they really were active in the M&A process and really helped support to make sure that the company sold, that the deal never died, that the company never ran out of money, and particularly because there was this market, right? So there were companies that were buying companies like this. So you know that if you stay in the game long enough that you too, provided that your tech works and everything is okay, should be able to sell that company and realize the return on the investment. So really good investors there. And then in the end, you know, management being focused on liquidity. And so what I mean by that is when I joined Butyl, there was a mandate, and the mandate was sell the company. It was, of course, build products and have happy customers and this kind of thing, but it was really a licensing business, right? So you're not dealing with you know, the 10 million user kind of objective. You're dealing with a you know, a company that's built that at this stage is you know, is looking for an exit. So the mandate was sell the company, and the management team. We were, let's say, compensated in such a way that that invited us or encouraged us to focus really on that goal. So how can you do it? And I guess that's kind of the question relevant to this conversation here. So here's one way, and you know, this is just one way. So of course there are a lot of different ways that you could start a company and that you could sell one anywhere in the world. This is the model that was applied with Butyl, and a model that I've also used in Ukraine and in Poland here now as well. Okay, so unicorn free zone. Besides being kind of a very scary image, yeah, it is pretty scary. You think unicorn should be a happy thing, right? But the first thing we do is if we're in a market that doesn't have billion-dollar startups, multi-billion-dollar startups, which I don't want to be the first one. I mean, sure. In my heart of hearts, I do, right? But realistically, when you're in a market that, let's say, hasn't had a company in the tech space that's had, you know, venture investment exit for you know, some multiple of $100 million, right? Then, you know, you probably want to try to aim. Hey, you know, aim low is kind of a negative thing, so let's not think about it like that. And let's not be realistic, because being realistic just fucking sucks. I don't want to be realistic. But in any case, you have to kind of think about the market that you're in if you want to stay in this market as a base of operations, wherever that is. You know, and not try to invent Snapchat. Yeah. So focus on incremental data points. So you look at the largest exit in the market, and this is, you know, not something that we do often when we're starting a business, right? So if I'm back, you know, I moved back to San Francisco 6 months ago, and you know, when I'm in San Francisco, I don't have to think about, okay, so I'm building this business, I'm solving a problem, and you know, what's the let's say, like, you know, the maximum that I might be able to get back from this. What's the value that can be extracted in an exit of this company? Like best case scenario, I'm not thinking when I have that thought, right, of the ceiling that might be applied because of the geography, right? So European companies, I think it was interesting that Vitaly pointed out that European companies tend to have a higher return on investments because they raise less money in general, maybe, or because they're more capital efficient. But you know, European companies also trade at like a 30% discount. And what I mean by that is if I had a company in the US or in San Francisco, more specifically Silicon Valley, and a company in, I don't know, any large European, I mean, let's like exclude Poland, not because we should, but just so that it's not insulting. But let's say you were, I don't know, in Paris, let it be, although that's not a great place to start a company. You'd probably trade at like, you know, 30% discount, right? So what that means is if you had two of the same business, one is in San Francisco, one is in Paris, identical in all shapes and forms and quality and everything else, the one in Europe is still going to be less expensive to buy than the one in the US, and even outside of San Francisco. So something to think about. The way that you can not only make some money, but participate in the development of the ecosystem in let's say, an emerging market, in a newer market, in any market really that's in Silicon Valley, is to help create incremental data points. And what I mean by that is look, look at the ceiling or the highest exit that's been in the market, and try to aim above that. If you can create a set of data points, this is the kind of thing, these are called comparables when you're looking at investments, right? So if I'm looking at what has another company in this space, in this geography, exited for, there needs to be data. And if there isn't data, then everybody's just kind of shooting in the dark. You end up with low valuations, and you end up trading at a discount. So focus on incremental data points, establishing some history in the market. As far as exits. So start, fund, sell, repeat. So the cool thing about this is a lot of times when you start a company and you take venture investment, the investors are looking at a 7 to 10 year horizon. And what that means, they're hoping, and this is not angel investors, but in general they're hoping maybe in 7 to 10 years you're going to have an exit. And this is important because I think a lot of times I know that when I've started a company, I haven't always thought about if I would still like to be doing the role of CEO at that company in a decade. When I'm 10 years older, am I still doing this thing? So in any case, if you don't go after the multi-billion-dollar exit, you can do this more quickly. So in the same way that you can be lean and iterate on product quickly, you can kind of cycle through these things and be involved in helping elevate the entire ecosystem. Right. So how do we do this? We start by picking a universal problem. So universal problem is something that is easy and simple to understand. So let's take, for example, antivirus. So everybody knows what antivirus is, right? And computers generally get viruses. This is a pretty simple thing to use. But computers get viruses. Okay, fine. And it doesn't matter whether you're in San Francisco or in Moscow or in Warsaw or in Cartagena, Colombia. It doesn't matter where you are. You have this problem, and if you can solve it, you can probably build a business around it. So it doesn't require much local understanding. It doesn't require really anything except solving the problem well. And I think in markets that are nascent, in markets that are in, let's say, varied states of evolution, it's important that you pick something that's easy and simple and universal. That's not like Snapchat, for example. Okay, so in this model, that means no consumer internet, no business software, no e-commerce. This is kind of strange because typically e-commerce companies tend to be some of the first exits in what we'll call emerging markets. So there's some of the first companies that start because what's the most simple fucking business you could build? It's buy shit online, sell shit online. It's just like the local corner market. So it's anyway the same. So you buy stuff, right? You buy and sell stuff. It's very simple. The margins are not so great. Of course, when we build software, we have much better margins. When we do e-commerce, we have high customer acquisition costs. You make it back the third order. It's just disaster. I've done e-commerce, and it's good and it's fine, and you have big revenue but small profit. But in any case, those are pretty stable businesses because usually you are not manufacturing the thing that you sell. Now, generally speaking, right? So we know people buy these products. So let's take soap, for example. We know people buy soap, so we're going to sell soap online. Okay, so it happened in the U.S. and it was a pretty big exit. We know people buy diapers. We're going to sell diapers online. So people do things like this, and they tend to be some of the first exits that you see in a market, but it doesn't fit the model that I'm talking about, so we're just not going to do it for now. Business software, the problem with business software. Oh, the problem with business software. So I had a company that came to me once and said, look, we are going to solve the problem of procurement, of small business procurement in the United States. This was not an American company. And I said, cool, guys, so what do you know about procurement in the U.S.? And they said, well, actually, we've never been there, but we read online that there's like a big problem with procurement in small businesses. So that's not great either. The other side of this, is, you know, if you get into building business software and you start building business software for the domestic market, that's also not great. So, I mean, when I set up my business in Poland, we tried to use some international accounting software, an international ERP system, but of course, all of them require some special vendor that gets the tax reporting correctly, and it's not supported by, let's say, SAP or NetSuite. These are business software companies. So we ended up having to use something that's just like made in Poland. For the Polish market, it was cheap. It was like a few $100, which is a little uncomfortable for me because I'm used to paying much more for ERP. But it was all we could use. So that's also not a business that fits this model, and it's not a business that somebody's going to come in from outside of the country and want to buy for a lot of money. And I mean, in consumer internet, the reason we stay away from consumer internet in markets like this is you know, consumer internet has to be global, it has to be universal. And it has to be usually solving some sort of, let's say, first world problem that often the markets that try to generate these new consumer internet products, you know, don't often have that experience. And so if you're not experiencing the problem, then you're probably not going to be very good at building a solution to it. So avoid those first world problems. We'll just move on from that. Right, so work with experienced investors. Now, here's why this is important. I mean, it's pretty obvious why it should be important, but in any case, so you're starting your first company, and maybe you've got some business background, maybe you don't. In any case, you've got some solution to a problem, so you start your first company, and you go to some investors, and they're like, wow, we really like this idea, and we're going to give you money. But you're starting your first company, and you've never sold a company. And these investors, I mean, they like your idea, and they got some money from somewhere, but they've never invested in a company like yours, and they've definitely never invested in a company like yours that sold to anybody. And so this is kind of like a lot of blind people trying to figure out how to cross the street without the sign making, you know, any noise or something like this, right? It's just bad news. So it's a challenge, but they're probably, for as many investors as there may be in the world, for whatever you're doing, if it's really good, those first investors that you'll have, there probably aren't that many people that fit the bill. There probably aren't that many people that at the stage that you want an investor to add value. That at that stage that they've had that experience, that they've helped take one of these deals across the finish line. I mean, because at the end of the day, that's what this is about. It's just as much about selling the company as it is about starting the company. It's great to start, but if you don't sell, then it's kind of like, why did you start in the end? So you have to try to work with experienced investors. I know that they don't always exist, so at some stage, like friends and family stage, then it is what it is. Even with angel investors, though, you want to try to have your investors add value. And if they can't add value, then, I mean, they're just kind of dumb money, and, you know, that's okay if you have the experience and you've done it before, right? So, I mean, you could kind of balance this either way. If you've got lots of experience and you've sold a company in the same space, you've taken it across the finish line, then fine. Take money that has never done it before because you probably get a better valuation. That means you give up less to your company because they're not sophisticated. But, you know, if you don't have the experience, you have to get as many people involved that do or that have, you know, and you take the best you can get at the end of the day, right? So no exits, not helpful. No exits, not helpful. Doesn't matter whether it's an accelerator, an angel investor. I mean, would you? Let's use a silly analogy. Would you bet on a horse that had never won a race? I mean, and I don't know. I don't bet on horses, but I mean, this is the kind of analogy that I can make. So, I mean, this is like, you know, giving money to a friend to play poker that always loses. So you don't want to do that. If there are no exits, then, you know, even in a market where there's an easy excuse here, by the way, which is like, well, you know, the market is early and nobody's had an exit yet, so great. You're talking to somebody that just gave a bunch of people a lot of money and is hoping that something happens. You know, and you know, at the end of the day, there are all sorts of different profiles of investors, but it's important. No exits, not helpful. Yeah. So what can you do? So you get help, and I think that when a lot of people think about getting help for their company, for their startup, they think about something, you know, like this, particularly if you're in business software. You get some old guy in a suit. They're not that old, actually. That guy is. So you don't really need help like this. You know, you don't want like the retired professional that had experience in some distant business that was somehow similar to yours, or just knows how to run a business well, because they won't know how to run your business well. And every business is pretty different. Operations, things like this, these can be commoditized. Sure, to some degree, executive management can be commoditized, but you really need help that looks a little bit more like this. And of course, the American comes and says, this is what you need because that's what we do, but I don't really mean like this. But what I mean is you do need people that are really going to be tactical and strategic about how they solve the problems, and that doesn't really matter how long they've been in business. It matters if they have sold a company in this space. So establishing a global footprint, and this is something that we did at Butyl. It's something that I've done with my business in Ukraine, and what you do, what this means. There are things that in every market, even in San Francisco, that we don't do so well. So let's say it could be sales and marketing, it could be product management, it could even be executive management. And so another way to look at this is thinking, okay, so what we're going to do, we're going to outsource the things that we don't do really well. Now, not really outsource, but we're going to open an office. We're going to and use that to establish a global footprint. So outsource the things that you don't do so well out into geographies where they have more experience. So 4 steps. Pick a problem that is universal. Take outside funding that has some experience. Recruit some experienced management, so that has some experience taking a deal like this across the finish line, and then try to manage the perception of geographic risk. So you don't have this so much in Poland. I have this in Ukraine, where I mean, we have very real geographic risks. So as much as I can go in and say, well, it's not so bad, and actually, everybody could leave, but there is real geographic risk there for an investor, and so you have to create a model in your business that allows you to balance that, even if it's only in perception. Now, that doesn't mean that it's not going to come out in diligence, right? So you can't say like, hey, I'm based in San Francisco, and there's, just me, and I come, every 3 months, and we have a mailbox. So that, that'll come out, but there's sort of customer-facing communication and investor-facing communication. So maybe for customers, if you're targeting a specific market, it's okay to do something like that. With investors, obviously, nobody's going to write you a check that hasn't, looked under the hood, right? Or up the skirt. Yeah, okay. So a blueprint for emerging markets. So this is what this looks like. You could start a company, right? So probably before you start a company, you should think about, this problem, but identify a universal problem Add experienced investors. If it works, then actually bring on a management team that's had experience selling the company. By the way, I just blew through the first 3 to 5 years of the business. But bring on executives that have experience selling a company in your space, or at the very least, just experience selling a technology company, selling a startup. And it's very different than selling, I don't know, a grocery store, right? So just because you have experience in business, that's great and it's wonderful, but the way this thing works, it's not the same. So if it works, you bring on the management team, you establish this perceptual global footprint, if nothing else, and then you sell the company, and you focus on selling the company. So this is one thing that becomes a challenge when you're building the business, because you're trying to build product, you're trying to acquire customers, and you're trying to sell the company. And the selling the company part you can't do right away, right? So you have to go through this whole process of building the company, growing the customers, growing the business, and then only at a certain point do you start thinking about selling the company. And you're not going to be sitting around somewhere one day you're going to get a call from Mark Zuckerberg and he's going to be like, hey, I want to give you $4 billion for your company. It happens every Instagram in a while. But at the end of the day, companies are not bought. Companies are sold. And I think that's a really important thing to think about. So it's not enough just to build something great, to build something fantastic. It just becomes a company then. If you want to sell it, then you actually have to focus on that, and that becomes your objective as a CEO. And so thank you very much. I believe that is the end of my presentation. Again, there are lots of ways to do this, so whatever you're doing, if it's totally different than this, don't be discouraged, but this way works pretty well. So thank you very much.
Thanks, Jonathan.